Okay, we'll go ahead and get started. I think we've got just about everyone we were expecting to join. So welcome and really appreciate the time that you all have given us to provide a webinar on what we feel is a very innovative, happening here in the fuel industry and within pay term optimization. And also, you hear a lot about AI, artificial intelligence, and you're going to see how artificial intelligence is weaved into this presentation as well. But the title of this webinar is Driving Financial Growth, the Roadmap to Fueling Working Capital. I'm going to go ahead and start sharing a presentation here. So you all should be able to see this presentation. Go through the agenda real quickly. We'll have the webinar overview, setting the scenes for bulk fuel purchasing and payment terms. What is new and innovative about Calculum and FuelHub, and how does it add value to the industry? And then the Q&A and conclusion. So we plan to get through the vast majority of the webinar in about 30 minutes, and then leave about 15 minutes for the Q&A and conclusion. Some housekeeping information. This presentation is being recorded. Recording may be shared at a later time. And please use Q&A to ask a question, which will be answered at the end. Your lines are muted. So quick introductions of the team here. So myself, Ramel Lindsay, been with US Bank a little over 12 years in product program management, strategic partnerships, business development. I lead our Voyager sales team now, which sells fleet cards into the private and public sector, commercial sectors of the US primarily. So if you think about the Postal Service or Amazon, those are some of the clients that we have that use our cards. Prior to being at US Bank, I was with MasterCard for a little over 7 years. And before that, I was in the oil industry, working for a Midwest-based oil company that also had refinery operations. Joining me is Oliver Belin. He's the co-founder and CEO of Calculum, with over 15 years of expertise in supply chain finance and credit finance solutions. Oliver's no stranger to the world of trade finance. He founded Swiss Commercial Capital, which was acquired by Macquarie Bank, and authored 2 supply chain finance solution books. Don Thibodeaux, he's a co-founder and CEO of FuelHub. Don brings in extensive background in fuel operations, consulting, and sales, with expertise in optimizing fuel operations and financial efficiency. And I'll be moderating, asking some questions throughout, as well as Don and Oliver. And like I said, we'll open up the session for Q&A at the end. So first off, why is this topic important? Cash is king again, certainly. Considering the environment that we're in, protecting your working capital efficiency is essential. And the environment that we're in being rising interest rates, liquidity crunch, capital constraints due to the recent banking crisis. So cash definitely is something that many of the executives are reviewing and looking at how to improve working capital, since the pandemic, but certainly has been further heightened, going back to earlier this year, once again, due to Silicon Valley Bank and some of the other banks that failed, some of the smaller regional player banks. There's also a focus on supply chain risks. And you go back to the pre-pandemic days, supply chain risks were always kind of a bit in disruption due to the over-the-road space and truckers who were starting to age out of that workforce. So you had some of that going on from the perspective of those dynamics, and then getting into the pandemic and after the pandemic, certainly everyone was fully aware of the supply chain risks that came to bear there, with tons of containers being stuck on the docks and whatnot, and so you just couldn't get the product out, and you didn't have enough drivers to get those products out. So there were many, concerns and issues about supply chain risks, which is demonstrated here, with 79% of the companies considered being proactive and prepared for supply disruptions when you consider what just occurred or is still occurring within the industry. Now, pivoting to a point that we believe will kind of help alleviate some of these tensions in the marketplace are new technologies such as AI. So certainly a lot of folks have heard about artificial intelligence and Chat GPT-4, and how that's going to, kind of change the world, if you will. But we have on the line with us Oliver Belin from Calculum, and he's going to talk about how AI is actually incorporated into their tool and how that can be used to better improve supply chain risks and ultimately alleviate and hopefully eliminate those supply chain risks. So why is the topic important? Around 70% of the organizations have annual performance targets for working capital improvement. So we know from a bank perspective that many of the large corporate, commercial, public sector clients are very much targeting working capital improvements. Once again, going back to cash is king and ensuring that they're focusing on the right initiatives and that they're improving that working capital due to the cash crunch, liquidity crunch from a banking standpoint of view. So from a fuel purchasing, bulk fuel purchasing standpoint of view, you begin to kind of see similar dynamics if you look to the right of the slide that you would see across, really all industries. So if you look at this question, as a supplier, have you been asked to accept longer payment terms over the past 12 months? And emphatically, yes is the answer. So if you look at 2023, it is a yes across the board, really, in all these categories. So when you look at the fuel industry in particular, the fuel industry is, typically 10-day payment terms for bulk fuel purchasing. So contract fuel purchasing, the suppliers, be it the refiners or the wholesale bulk fuel suppliers, they typically do not want to provide anything longer than 10-day payment terms. They're not banks, and they're not in a position to provide the longer payment terms, generally speaking. And once again, going back to the capital crunch and cash being king, they'd rather, free up those resources instead of extending payment terms. That is, they'd rather get paid quicker than extending payment terms to their current buyers. But when you look at the space, there's this cash crunch, credit liquidity. So the buyers, want the extended terms, but yet you have an issue with the suppliers who want to really bring those terms down. So that creates that natural tension. So that is a perfect segue into what Don Thibodeaux at FuelHub will cover off on, as far as what are the current challenges and opportunities within the industry, and really how can FuelHub and this team address those challenges. So Don, I'll let you proceed from here.
Thank you very much, Ramel, and good to be with you and Oliver this morning. So at FuelHub, as you know, we advocate on behalf of bulk fuel buyers. And why that's important is because unless you are a retailer, you don't tend to have your own internal fuel team that has the expertise, the tools, the processes, the know-how to buy effectively and optimize your supply chain. So we step in, cover that gap for companies where and when they need it. One particular use case that I'd like to talk to illustrate this slide is the commercial buyer. So when I say commercial buyer, just to define that term, I'm talking about a fleet customer or a government customer or a commercial and industrial customer, a mining company, let's say, or someone who uses fuel as an input. When you have that type of customer, the disparity is that when they consume fuel and are invoiced, as you mentioned, that invoice is typically due day 10. On the other side of that, that commercial buyer does not tend to get paid from their customer until 30 to 45 days out. And so when we talk about an optimization program such as pay term optimization, which we have with US Bank, we take that both ends of that extreme and stretch them out. So at the top there in blue, what we offer through the program is a 75-day pay term. And if you think about that in context of the 45 days that the commercial buyer takes to get paid from their customer, now you have a scenario where they don't have to float cash to pay for the large spend category that is fuel. So it's good not only for their customer, in terms of them being able to add value and give the customer at a time when they need it most relief and reprieve to protect the integrity of the supply chain, but they also, on the other end of the spectrum at the bottom, are able to accelerate payment to the supplier. Contextually here, if you think about the average customer profile that we see, it's about 12.5 million gallons annual that they consume. Well, if you're buying diesel at say $4 a gallon, that's 50 million in annual spend. So you can see very quickly that as a lever, this has the potential to really create a lot of value for all parties concerned. And so down there at the bottom, the payment, the notion of paying on that type of spend in a time frame as quickly as 1 day versus 10 days has a net effect of benefiting the supplier as well. So here you have really with this opportunity and supply chain optimization in general, the opportunity to create the rare win-win scenario. Oliver or Ramel, would you add anything else to this?
I mean, maybe just to, guess most people know that, but when we speak about a few days improvement, if you add it up for a large organization, we spend, let's say, 100 million, this has huge impact just by optimizing a few days and help you generate cash, which you don't have to borrow and pay higher interest rate, which you can use for R&D, for expansions, for acquisitions in general, just to be more competitive. And what most people don't realize is if you are at the lower end of payment terms compared to your peers, this is great. But usually what it means is that you're financing indirectly your competitors. So when it comes to payment terms and working capital, it's not just looking at yourself in terms of organization, but looking at your peers and your competitors and gaining this competitive advantage. Because this is key in the market, using working capital, using payment terms to gain this advantage.
Yeah, I would agree, Oliver. And sorry, I think I might have gotten muted there unintentionally, but I was trying to respond to Don. I would echo those points that Oliver was making, that the going back to kind of cash is king, and the liquidity crunch, working capital being paramount. That ties really into being able to extend terms up to 75 days, giving those organizations an opportunity to kind of redeploy that working capital to focus on other higher priority initiatives, perhaps M&A activity, as Oliver stated. And also, on the flip side of that, from a supplier standpoint of view, now they can get paid in quick as 1 day, which for them also improves working capital and cash flow. And thus they can also then focus on more important endeavors within the organization, including M&A or capital infrastructure projects. Great.
Yep.
Okay, Don, I'll ask you then about the value proposition within the fuel industry, and how pay term optimization, really provides value across the entire supply chain here.
Definitely, Ramel. Thank you for this. So the context here to keep in mind is that the supply chain has several constituents. You see them outlined at the top. There's the fuel buyer, of course, and then there's the wholesale supplier that typically will supply most fuel buyers, and then there's the refiner that actually makes the gasoline and the diesel that makes its way into the market. All three of these are the primary stakeholders. And what I want to emphasize with this slide is the notion that there's not one stakeholder that has to lose in order for another to quote unquote win. So when we talk about the value props along the left-hand column there, I want to call these out and show you how they complement one another and work together. So first is the notion of an accelerated payment, which is what a program like pay term optimization does. But in general, when you're talking about the fundamentals of the analysis that Calculum provides, it gives you the insights into that impact of what an accelerated payment does. So from the fuel buyer standpoint, accelerating payment to the wholesale supplier is an absolute value to them. In turn, that wholesale supplier can accelerate payment to the refiner, and in some cases, in all cases, the wholesale supplier is a buyer of fuel themselves because they are buying from a refiner. So accelerated payment is the first and foremost value proposition for those two stakeholders. And when you're talking about that value, inherently you're talking about the time value of money. So $1 today, as we all know in school, is worth much more than $1 tomorrow. Secondly, extended term. This, of course, goes to the fuel buyer as the inherent value add. So the slide prior, we talked about them not getting paid from their customers until 30 or 45 days, typically. This scenario has them going out beyond that to 75 days, where they can comfortably receive payments from their customers and in turn pay the rest of their supply chain. Discount leverage. So the third PPG refers to points per gallon, which is the common vernacular in the fuel industry. Points per gallon discount leverage. The value there is for both the fuel buyer and the wholesale supplier, because anytime you're talking about accelerating a payment, taking time out of the equation, there's inherent value in that, time value of money, credit risk, et cetera. And so what happens is now you can sit across the bargaining table and you have a business case for getting a discount on the price of fuel. As we're talking about very large sums of money. So even a few points here or there, half a penny, a full penny, you're talking about a scenario where there's several $100,000 in savings in play. From the wholesale supplier standpoint, the value makes its way up that ladder of the supply chain, in that the discount is not exclusive between the fuel buyer and the wholesale supplier, but that wholesale supplier also has an opportunity to have the same type of discussion, negotiation, pencil sharpening with the refiner that supplies them. Specifically in the case of the pay term optimization program that we have the ability to hone in on, it's not an all or none proposition. We have the ability to hone in on a specific subset of fuel invoices within a particular customer's or wholesale supplier's portfolio. So this gives the ability to be specific and precise with respect to where this type of solution gets deployed to. Credit risk, elimination of credit risk. So a lot of times what you have in the case of the downstream fuel supply chain is you have wholesale suppliers and you have refiners who assess credit maybe once a year or maybe twice a year. The paradigm shift of late is that now you have a different dynamic in the market whereby yesterday's credit-worthy candidate, because of supply chain disruption, because of increased interest rates, because of an uncertain environment, they might not be today's safe bet. So what happens in a program like pay term optimization is that risk is completely offset and absorbed by US Bank in the case of this program. And what that means is that now there's no longer the need to have things such as credit risk insurance. There's no longer the burden on the part of the accounts receivable department to chase payments. And then last but not least, I think this is important to any organization in this day and age, is the notion of IT burden. Whatever is deployed, whether it's pay term optimization or any other program, business disruption is certainly something that organizations are keen to minimize. And so from the standpoint of this particular solution, we're talking about how quickly you can get the Calculum analysis to support decision making to actually implementing the program. The IT burden for all stakeholders is a non-factor. Guys, anything you'd add?
No,
Yeah,
I think you
maybe,
covered that well. Go ahead, Oliver.
Maybe just one thing I want to add. Yeah, I mean, obviously, this slide explains very clearly that somebody's AP or accounts payables is the other party's receivables, correct? So when you're just looking at your own four walls, this doesn't work anymore. You have to work hand in hand with your suppliers or your customers when it comes to improving your cash to cash cycle. And such a solution where you work with a third party, which basically provides benefit in collaboration with suppliers and customers, is very important, and it's used by leading organization. And the second thing I want to say, which is great in this slide, is some of the leading organizations have started not just looking first their own four walls, but as I said, looking at their partners. And now the next step is looking at the second tier suppliers. So looking at the whole supply chain, because then you can really make big changes, big improvements, and you can see the risk way ahead of time, because usually the risk is not the first tier, it's the second tier or even third tier suppliers.
Yeah, and Oliver, I think that's a great segue into this next slide. So what is new and innovative about Calculum, the FuelHub partnership that was just recently developed, and the implications and the value to the fuel industry that both FuelHub, now Calculum, and US Bank bring to the table?
Yeah, so we're speaking here about a financing solution, correct? And when it comes to, everybody knows in the audience about the supply chain finance or reverse factoring programs, which basically helps both parties, supplier and suppliers. It's great on paper, and most companies have set up good programs, but a lot of them have not achieved the results which was expected. And the key reasons, looking at many programs worldwide, is that organizations always focus on pricing first, or the accounting treatment, or the legal documentation, or selecting the right structure. And what this slide wants to highlight is, before you're starting such program, you really have to do your homework. So you have to analyze your spend. You have to analyze your trading partners, could be buyers or suppliers, and you have to set up the right goals, the right timing. And only then, once you analyze and you build different scenarios and simulations, then you can start with the program design and then be really successful with such financing solution. The second point you see here, the largest circle, is onboarding trading partners. As we explained before, it's not just a solution just for you, but it involves your trading partners. Mostly when it comes to suppliers, obviously it's procurement. And what we have seen in the past is procurement departments and team members they are very good at finding the right pricing, but they don't have the right tools, the right insights when it comes to payment terms or risk assessments of their suppliers. So, and then also explaining to their trading partners, their suppliers, what is the benefit of joining such a financing solutions. So come back about the analysis and the insights, it's very important to also provide this information, not just for treasury and finance departments, but also for procurement when they're speaking to their suppliers. And I think this is a good segue to the next slide,
Great.
about AI. So when it comes to analysis, obviously AI is the new kid on the block and everybody's speaking about it. And it goes obviously way beyond ChatGPT. Today in treasury and finance, and you see here, it has started that companies are using it. It's not mostly themselves, but they use it in conjunction with third-party providers, which are specialized in leveraging this new type of technologies. And mostly in treasury, we see they're using it for mainly cash forecasting. So looking at past cash flow needs and then forecasting upcoming ones for collection and for credit risk analysis. And it's mainly not like, the investment grade or public listed companies, but for when we speak about supply chains, these are private companies in emerging markets, for example. So their AI type of solutions, which are leveraging not the typical data points where they're not available, play a big role when analyzing credit risk. And then obviously leveraging AI to improve working capital. So that means optimizing payment terms, looking at your peer groups to see where you are standing versus your competitors when it comes to payment terms. And and I think this is not something new for everybody, but there is every large organization in every sector we see today are planning, have clear use cases for leveraging AI in treasury, in corporate finance. I think there was just an article, correct, Ramel, from US Bank on this topic, how treasury is using it for efficiency in transactions when it comes to payables and receivables, cash flow forecasting and controls. I want to go also beyond. Yeah. And I also want to go beyond quickly on procurement. So procurement is also using it today mainly for looking at vast databases in terms of analyzing suppliers, also leveraging data when it comes to minority suppliers and ESG, a big topic which we see today. Then predictive analytics when it comes to purchasing, so which I think is also very important in the fuel industry. So looking at purchasing requirements, looking at forecasting based on historical data, market trends, when it comes to weather, economic indicators, and then automated contract analytics. So looking and helping analyzing contracts, clauses, flagging risk and compliance issues, and then evaluating the performance of suppliers, which we also do at Calculum. So we analyzing how they are doing in terms of credit risk or general financial performance, estimating their funding costs, and looking for ways to improve payment terms. Now, when it specifically on working capital, obviously, the first point being much more efficient when it comes to managing working capital, and again, looking at payment terms, how to be aligned with the market so that you are not the only one which is at the lower end, where again, you're financing your competitors, but where you are aligned with the market and with your peers. And then specifically looking at risks and not only the first tier, but the second tier suppliers, and looking at new alternative ways for scoring such suppliers. Then peer group performance analysis. So comparing yourself, this is not just a one time, but constantly looking at yourself versus your peers, finding where you can improve it to be aligned with the market. And then then again, finding ways to uh, optimize your terms and not just using data, but empowering procurement and treasury to help them negotiate either terms when it comes specifically to speaking and negotiating with suppliers.
And Oliver, I think this would be a good time maybe to do a quick demo. We did start about 5 after or so I think we still have a couple minutes left, and unless you've got any other points you wanted to add.
No, true. I mean, I think it's good because it's something new, right? So let me show you the platform. So the platform today, we are growing very quickly. I think we have 1.3 million suppliers right now, which have been analyzed. And basically, the platform allows you to upload very easily your supplier and your spend. And the platform tells you then your concentrations, where your suppliers are located. Very important, it rates automatically, analyzes the credit risk of each single supplier. And then you can simulate different programs. So you can say, hey, I want to go after discounts, or I want to go after cash flow. And then the platform looks at, for example, here from your current terms, what should be the optimal proposed terms to be aligned with the market, and then what is the potential cash flow with a lot of different breakdowns where you can drill down in terms of, like, for example, what is the biggest probability of success that these suppliers will accept these new terms, and what is the biggest impact on the buying organization in terms of cash flow. And not going into detail, but just want to show you that the data is not only available on a portfolio basis, but it really gives you all the insights on each single supplier. Looking also at the parent organization, different sister companies, and providing insights on the rating, on the funding cost, on the leverage, so how much the buyer has the leverage on each single supplier, and then providing you all the different argumentations when it comes to negotiating with suppliers, and to make it even simpler, to provide you a script for procurement to go step by step explaining what should be the right argumentation when it comes to payment. This gives you a good overview. So back to you, Ramel.
Thanks, Oliver.
I think we have one more slide left, correct? Yeah.
That's it. Yes. So I'll let you speak to this as well, Oliver, regarding the complementary calculum analysis.
I'll actually jump in and take that one, Ramel, and then bounce it back to Oliver here. But let me just say that one, that was every time I see it, you know, it makes me smile seeing the demo and the power of the Calculum platform. And so, you know, I'm super excited about our partnership, Oliver, with yourself and the rest of the Calculum team, and what it means for FuelHub's customers. And we believe in it so much that we want to offer a complimentary Calculum analysis to our customers that are considering our pay term optimization program. And the value and the significance of that is that although the notion of supply chain optimization, supply chain financing has been around and ubiquitous for quite some time, it really does not have a presence in the fuel domain. Traditional ways of handling this have been to use one's own cash, has been to use a revolver, in some extreme cases, factoring, all of which are suboptimal, let's say, for addressing the problem in such a large spend category. And the significance, again, in the fuel domain is that a little lever, a little optimization here or there that creates points per gallon advantage is tremendous when you're talking about the dollars and cents involved. And so what we want to offer for those that are interested in deploying this from a fuel standpoint is we want you to get the complementary Calculum analysis. We want you to get the get the model that shows you exactly what your optimal scenario is. It'll model it for yourself as the buyer. It'll give you insight and awareness into what to ask for from which supplier and why. Once you take that decision support information and execute with us through the pay term optimization program, after a month of being on program with us, we'll credit you back the cost of the Calculum analysis. And again, it's not just for fuel, but it's also for adjacent categories and your supply chain in general. So Oliver, you want to expound on that at all? Maybe talk about the success stories and what value can be extracted on average.
So just to, I see here, and I know we have a Q&A session just after this slide. I see a question which came up. It's like how to get started. I want to highlight that in this slide. So how to get started, if you want to make use of this insight, it's very, very simple actually. The platform, which I just showed before, only needs 6 data points to get started. So usually we work with very large organizations, but also small ones in multiple different industries, is to sign it, obviously mutual NDA, and then provide a template. Basically, it's an Excel file which has must-have data points. We only need 6 to get started. So we only need to know who is the buyer, who is the supplier, the volume you're purchasing, the currency, the actual payment terms. Okay? And then the platform does the rest. We analyze usually to get started like 100,000 suppliers. It takes a few days. Then we usually invite the company to present the figures on the platform, and then they can see already how they are versus their competitors, their peers, and if there's potential to improve. Usually there is. But then what I want to say is, usually we see between 8 and 14% of opportunities to improve working capital for every dollar spent analyzed. However, very important, the platform tells you where you are and where you should be. But how to get it, it's you have to pick up the phone, renegotiate the payment terms, and work with a partner like FuelHub and a liquidity provider, which then really can inject liquidity and make your whole supply chain much more resilient and much more competitive. So this is why, coming back about this partnership, today's webinar, I think one part alone, it's not very efficient. You have to be most effective. You have to have all parts together to really get the most out of your supply chain and the most in terms of working capital improvements.
Great, thanks, Oliver. And I think that's a good segue into the Q&A session. And I know we have at least one question I saw earlier. The question is, what are the terms of the 75-day monetization? Floating rate or fixed? What is the security? So the way pay term optimization works, and this is where US Bank steps in as a partner with Calculum and FuelHub, is we provide the actual line of credit to the buyer. So we're therefore providing, the 75-day term with the line of credit, which is unsecured, to answer that last part of this question. We do weekly billing. So if it's 75 days or 60 days, 30 days, whatever that term might be, we bill every week. The client can choose any day of that business day week, so Monday through Friday, as their billing day, and then we will bill them every week and have those terms out to whatever payment terms that they have requested and we've credit qualified them for. So weekly billing, net 75, for example, in that instance. The rate, the second part of that question, is actually fixed. So we do charge a fuel finance fee on the dollar amounts. So the invoice dollar amounts that we receive for all the invoices that come through for fuel financing, we charge a fixed rate, which is fixed for the 3-year term of the agreement, which in this environment is pretty important considering how interest rates have been rising and may continue to rise going into next year and perhaps beyond. So I think I've addressed that question.
Yeah.
Other questions?
I see here.
So if there's any, yeah, I saw if there's any geography limitations. So we are limited to the U.S. at this point in time. So long as the entity is based in the U.S., U.S. Bank can underwrite and contract with that entity. So even though you might have, for example, Canadian-based entity, but if they have a U.S.-based headquarter office as well, we can contract with that U.S.-based office. But it is all predicate on a U.S.-based headquartered office. So we would not directly contract with someone in Canada or Europe for that example.
Yeah, maybe from our side, when it comes to analytics, obviously, and when it comes to supply chains are global in nature. So, by the way, this question comes up quite often. So there's no limitations in terms of jurisdictions or where the suppliers are located. Usually, it's in countries which exporting a lot. So this is all Asia, South America, Europe, North America. Where we have the least data right now is the African continent. But and there's a lot of data also available, which we have in the fuel, gasoline, refinery industries.
Great. And a few other questions here. One I'll answer from the perspective of U.S. Bank. So, how do you get started? From a U.S. Bank perspective, it's really, from a contracting, know your customer, credit qualification. So we need to go through all those steps in order to credit qualify the buyer for the unsecured line of credit. And then we're able to move forward with the program, and generally a 2-week time frame with FuelHub. And then Oliver had already addressed kind of the inputs, if you will, the data points that they would need for the Calculum analysis. So I think we've addressed that question. One other question I saw are, what are the latest trends in the fuel gasoline industry? So Don, maybe that might be better served by you to answer.
Sure. Happy to take that one. So what we're seeing as we engage with the supply chain is that from a buyer's perspective, many are finding that their liquidity and their credit is actually drying up, and so they need programs such as pay term optimization to not only stay in business but also to grow. You've got then, as a result of the economy, you've got a situation where those who supply fuel really don't want extended terms because it's not good for their bottom line. They are in the midst of the struggle, as are all businesses. And when you're talking about a spend category like fuel, really the leash, if you will, is very short. So you see a lot of suppliers now reducing the lines with their buyers, or asking for more of a deposit or shortening terms, all of which are constraints that impede the ability of the supply chain to function as it normally would. So the topic that we're talking about is very timely. Fuel as an industry, fossil fuels in particular, is in the news all the time. Lately, there's the notion that things are going to change overnight. When those of us that are in the industry know better, we know that this is going to be a gradual transition. It's going to be around for a long time, decades to come. And as a result, these acute problems are not going anywhere.
Great. We've got
one other my side.
Sure, go ahead.
Maybe around my side, I the last year, so what we have seen, I was pretty surprised. So we, for example, analyzed a very large airline company, and also a logistic company. And obviously, they're one of the largest expenditures or costs when it comes to spend is fuel. We always thought that fuel is, because you're dealing with very large fuel providers, it's difficult to negotiate terms, but we see now a trend where there's opportunities to optimize terms also when it comes to very large fuel companies, and they are open to collaborate with their customers. This is good to see.
Great.
Sure.
And that answered another question that we had as far as how much data does the ADA platform currently have on the fuel industry. So I think you've addressed that question with that answer, Oliver.
Yeah, I mean, look, we all know the fuel industry, there's many different subsectors. We have analyzed a lot of oil and gas companies, a lot of companies which are using fuel suppliers. So yeah, we have substantial information, and we see already trends and peers which you can use to improve your own payment. So yeah, data is there. It's growing.
Great. And I see one other question, and I think we're probably about out of time after this one. Does FuelHub only specialize in the petroleum industry? Don, let you answer that one.
So the answer to that, the short answer is no. It's not just the petroleum industry. As far as the topic that we're talking about today, which is the notion of supply chain optimization, we can extend beyond just fuel as a commodity or category and get into other adjacent categories with respect to the program that we're talking about today. So think electricity, lubricants, think fuel services. All of these are within the umbrella of the same program dynamic that we talked about in today's webinar. And consequently, as a result, these are all categories by which you can model through the Calculum platform, the ADA platform, to understand exactly what levers to pull with whom, when, and by how much. So broader than just fuel, but it's such a significant spend category that we spend a lot of time on it because it opens up so much opportunity to talk about everything else and address everything else.
Great. And I'll add on to that as well. From a U.S. bank perspective, once again, we're the ones who are processing the invoices and providing the billing, extending the terms, providing the credit for the buyer. We can support other commodities, as Don stated. So the FuelHub team provides us with invoices electronically into our system. That's an automated process. So long as we receive those invoices through the system, the commodity really doesn't matter, and the extension of terms doesn't matter. You know, we don't change the extension of terms based on the commodity or the service. So to Don's earlier point, be it electricity, waste management services, even fuel-related services, so not just the bulk fuel purchasing, really any type of commodity or services that can be generated into an electronic invoice. We can submit those into our system by way of the FuelHub team, extend the terms then to the buyer while paying the supplier in as quick as net one. So our system is very flexible and can accommodate the different types of scenarios as far as commodities are concerned. So I believe that's it as far as the questions that we saw that came through. So I want to thank Don and Oliver, and also the Calculum team and the FuelHub team in general for supporting this webinar and supporting the solution, and appreciate everyone who's joined the call. Please make sure that you check back with us if you have any additional questions. Don and I are available, and so is Oliver, to address any additional questions that you may have submitted later that we might have missed here. But I think we've covered off on everything.
Thank you, Ramel. Thank you, Oliver. Enjoyed it, guys.
Great. Thanks, everyone.
Thank you. Thank you, everybody.
Bye-bye.
Bye.